For the first time in its history, China's most popular investment fund is not a stock fund. It is a gold fund. Golden Crest Finance takes viewers into a shift that surprised even seasoned market watchers. For years, ordinary people in China put their savings into a large stock fund, similar to how many Americans invest in the S&P 500. That fund was always the biggest of its kind in the country. But recently, something changed. A gold-backed fund quietly grew larger. It now holds close to $13 billion, compared to $12 billion in the old stock fund. In simple terms, more everyday people in China now trust gold with their money than they trust the stock market. This shift did not happen during a boom in gold prices. In fact, it happened while prices were falling. Earlier this year, gold reached a record high near $5,600 an ounce. Soon after, prices dropped nearly 30%, falling below $4,000. Normally, falling prices might scare investors away. Instead, buying increased. It was not only regular citizens making these purchases. China's central bank, known as the People's Bank of China, kept buying gold as well. Records show the bank added gold to its reserves for 20 months in a row. That is the longest streak seen since at least 2015. In June alone, the bank purchased close to 15 tons of gold, marking its largest single monthly purchase since October 2023. The buying goes beyond the central bank too. Over the first 5 months of this year, China imported roughly 700 tons of gold. Since 2015, total imports have passed 14,000 tons. These are not small or symbolic numbers. They point to a long-term pattern, not a short-term reaction to market prices. China is not acting alone. Central banks around the world have been adding gold to their reserves as well. In May, banks worldwide added a combined 41 tons. Countries such as Poland, Uzbekistan, and Kazakhstan have also increased their gold holdings. Very few countries have been selling. There's another important detail. Later this month, on July 24th, 4 of China's largest banks will stop offering certain retail gold trading services. This move is designed to push citizens toward owning physical gold, such as coins and bars, rather than paper contracts that only represent gold on paper. Officials appear to want people holding the real metal, not just a promise of it. Viewers may be wondering why this matters outside of China. The answer connects to events happening much closer to home. 2 weeks ago, the United States Treasury Secretary published an opinion piece in a major financial newspaper. In it, he described a return to an economic approach used by the United States in its early history, one connected to Alexander Hamilton, the nation's first Treasury Secretary. That approach focused on building strong domestic industry and protecting national economic independence. According to financial analysts studying this pattern, the ideas in that opinion piece may help explain why China, along with central banks across the globe, have been steadily accumulating gold. Some analysts have gone further, calculating that global trade imbalances could only be fully balanced if gold reached a price near $38,000 per ounce. That number may sound extreme at first glance, but it comes from real calculations tied to trade data, not guesswork. This is where the story truly begins. Viewers watching from around the world may be seeing the early signs of a much larger shift in how the global economy is structured, one involving industry, currency, and trust in paper assets. To understand where this story is heading, it helps to look back nearly 200 years. Golden Crest Finance takes viewers through the origins of an economic strategy that is suddenly back in the spotlight. The story begins on December 5th, 1791. On that day, Alexander Hamilton, the first Treasury Secretary of the United States, presented a plan to Congress known as the Report on Manufactures. At the time, the United States was a young nation. It had about 4 million people, most of them farmers. It had almost no factories. Nearly everything the country needed, from tools to weapons, came from Britain, the same empire the United States had just fought a war to separate from. Hamilton believed a country that could not make its own goods was not truly independent, no matter what its laws said. His plan had 2 main parts. First, tariffs, which are taxes placed on goods coming from other countries. Second, support for young American industries, so they could grow strong enough to compete with anyone in the world. This approach shaped the American economy for the next 150 years and helped turn the country from a nation of farmers into a major industrial power. Earlier this year, President Trump referenced this same idea during a public speech, describing a shift away from taxing citizens to support other nations, and instead placing taxes on foreign goods to benefit American workers and industries. This idea resurfaced again in a more detailed way on June 23rd, when Treasury Secretary Scott Bessent published an opinion piece in a major financial newspaper. The article was titled to directly reference Hamilton, connecting his historical strategy to modern economic policy. In it, Bessent outlined 5 guiding principles. The first principle stated that national economic security depends on the ability to produce goods domestically. Second, openness in trade should be matched by fairness, meaning if the United States allows imports, other countries should allow American exports in return. Third, the The article suggested the country would help shape new economic rules going forward. Fourth, it stated that financial tools, including the US dollar, remain central to national strategy. Fifth, it emphasized that economic policy should ultimately serve everyday American citizens. According to financial researcher Luke Gromen, who studies global trade and monetary systems, these 5 goals create a difficult balancing act. Rebuilding domestic factories, protecting affordable prices for average families, and keeping the dollar strong cannot all happen at the same time. Only 2 of the 3 are possible together. If factories return and prices stay low, the dollar likely weakens, since a strong dollar makes American-made goods more expensive to sell abroad. If the dollar stays strong and prices stay low, factories are unlikely to return, since cheap imports remain more attractive. If factories return and the dollar stays strong, tariffs would likely raise prices for consumers. This is where gold enters the conversation again. Analysts like Groman suggest that gold may serve as a kind of pressure valve, absorbing economic adjustments without directly damaging the dollar system. This is not a new idea. In 2009, following the global financial crisis, the governor of China's central bank published an official paper calling for a neutral international reserve currency, one not tied to any single nation. He referenced economist John Maynard Keynes, who proposed a similar idea back in the 1940s, based on a basket of global commodities designed to keep trade balanced between nations. At the time the idea was set aside, the United States, then running a large trade surplus, had little reason to support a system that limited surpluses. Today, the situation has shifted. The United States now runs large trade deficits, and some of the same arguments once made by China are now being echoed by American officials. Every economic shift leaves a mark on real people, not just charts and headlines. Golden Crest Finance now turns to what this growing gold story could mean for households, industries, and nations around the world. To understand the consequences, it helps to look at what history shows about powerful nations that once relied heavily on their industries. The most recent example is Britain. In 1846, Britain shifted away from strict trade protections and moved toward open, free trade with the world. At the time, this seemed like a sign of strength and confidence. Slowly, over the following decades, factories closed and industry shifted elsewhere. By 1931, Britain's global economic leadership had faded, and the United States rose to take its place. This transition took about 85 years, which is part of why it went largely unnoticed by everyday people at the time. Financial researchers, including Luke Groman, argue that a similar pattern may have started for the United States in 1971, when the dollar was no longer directly tied to gold. Over time, this made it easier for money to move away from manufacturing and into financial markets, a process often called financialization. Instead of investing in new factories, companies increasingly returned money to shareholders. Instead of employing local workers, many companies shifted production to countries where labor was less expensive. Stock prices rose, but the ability to manufacture goods domestically slowly declined. Consumers did receive real benefits during this period. Since the year 2000, prices for goods such as televisions, toys, and household electronics dropped dramatically, some by more than 90%. These lower prices made many products more accessible to average families. At the same time, prices rose sharply for goods and services that could not simply be imported. Housing costs more than doubled. Childcare costs rose significantly. College tuition and hospital expenses climbed even higher. This uneven pattern reflects a larger shift, one where certain sectors of the economy became far more affordable, while others, closely tied to local labor and infrastructure, became far more expensive. This is why some economists believe the United States may now be attempting to reverse parts of that process, rebuilding domestic industry while trying to protect everyday consumers from rising costs. However, as explained in Part 2, this balancing act is difficult. Choices made to support one goal often create pressure on another. Gold plays an important role in this discussion because of its unique position in the global financial system. Unlike a country's currency, gold is not controlled by any single government. It cannot be created or printed. For this reason, some economists and officials have historically viewed it as a neutral asset that could help balance trade imbalances between nations without directly benefiting or harming any one currency. Robert Zoellick, a former U.S. Treasury official who later served as president of the World Bank, wrote in 2010 that the world should consider using gold as a reference point within the global monetary system. In 2016, economist Kenneth Rogoff, formerly the chief economist at the International Monetary Fund, suggested that emerging economies should hold a larger share of their reserves in gold, partly because gold does not carry the same risk of losing value through oversupply, the way currencies can when too much is printed. Viewed together, these statements, along with China's ongoing gold purchases and the recent commentary from U.S. officials, suggest a broader global conversation is taking place about the future role of gold in the financial system. It is important to note that experts remain divided on how this situation will unfold. Some believe this shift could take place gradually over many years, similar to Britain's slow transition in the 20th century. Others believe more sudden economic pressures could accelerate the process. Both perspectives agree on one point. The world is paying closer attention to gold now than it has in decades, and the reasons behind that attention appear to be well documented, not speculative. According to financial researcher Luke Groman, there are two broad paths this situation could take. In one scenario, efforts to rebuild domestic industry in the United States face ongoing challenges. Debt continues to grow, and confidence in the current financial system weakens over time. In this outcome, history suggests investors often turn toward gold, since it is viewed as an asset that does not rely on any single government or currency. In the second scenario, industrial rebuilding efforts succeed gradually, and global trade becomes more balanced over time. In this outcome, gold could still play a larger role, but as part of a more controlled and managed shift, rather than a sudden one. Groman and other analysts note that both paths point toward gold playing a bigger role in the years ahead. What remains uncertain is simply how quickly and how smoothly that shift takes place. For everyday investors, this raises an important question worth thinking about. Should portfolios rely only on traditional assets, or does it make sense to understand how commodities like gold have performed during past economic shifts? Data referenced by financial researchers shows that since early 2018, when trade tensions between the United States and China first began, stock market gains have looked strong when measured in dollars. However, when measured against gold instead of dollars, those same gains appear much smaller and, in some cases, negative. This comparison does not predict future results, but it does offer useful historical context for viewers trying to understand how different assets have moved relative to one another. It is worth remembering that predicting exact timing in financial markets is extremely difficult, even for experienced analysts. Groman himself has stated that this transition, if it continues, could take many years, possibly more than a decade, to fully play out. Sudden price jumps to extreme levels are not expected overnight, and markets often experience corrections along the way, even during long-term trends. Viewers are encouraged to think critically about this information rather than react emotionally to it. Understanding a trend is very different from deciding how or whether to act on it personally. Financial decisions should always be based on individual circumstances, and consulting a licensed financial professional remains the most reliable way to apply this information to a personal financial plan. Nothing in this discussion should be considered direct financial advice. Several developments are worth watching in the coming months. These include upcoming changes to gold trading rules in China, continued statements from U.S. Treasury officials regarding trade and industrial policy, and ongoing data on central bank gold purchases worldwide. Each of these details may offer further clues about how quickly this broader shift is progressing. Golden Crest Finance will continue to track these developments as they happen, breaking down complex financial and economic news into clear, easy-to-understand explanations. Viewers are invited to share their thoughts in the comments below. Do these historical patterns feel familiar? Does this shift toward gold seem like a long-term trend or a temporary reaction to short-term events? Sharing perspectives in the comments helps build a more informed community around these discussions. This story reflects something larger than daily price movements. It touches on how nations build wealth, how trust in currencies is formed, and how history often repeats itself in ways that are not always obvious at first glance. Understanding these patterns may help viewers make sense of economic headlines for years to come, not just today. Thank you for spending this time with Golden Crest Finance. Viewers who found this discussion valuable are encouraged to subscribe, so future updates on this evolving story arrive directly to them. Until the next story, stay informed, stay thoughtful, and thank you for watching.